If I had to start over in 2025 with zero investments, zero assets, and only a little cash to deploy, I wouldn't jump into risky meme stocks. I wouldn't try to time the market. I wouldn't even bother picking individual stocks unless I had a serious edge. Instead, I'd build my financial foundation with just 3 exchange-traded funds, ETFs, designed to create wealth through exposure to growth, resilience, and long-term trends. These aren't random picks. Each ETF represents a different pillar of a well-balanced, future-ready portfolio. They offer diversification, lower volatility than single stocks, and exposure to the most powerful forces shaping the markets over the next decade. The first ETF I'd buy is VTI, the Vanguard Total Stock Market ETF. If I'm starting from scratch in 2025, my top priority is broad exposure. VTI gives you ownership in nearly every publicly traded U.S. company, over 4,000 in total. That includes giants like Apple, Microsoft, and Tesla, but also thousands of small and mid-cap companies flying under the radar. It's the ultimate one-stop shop for long-term U.S. equity exposure. Why VTI and not just the S/P 500? Because VTI captures more of the market. The S/P 500 gives you exposure to the 500 largest U.S. companies. That's powerful, yes, but it leaves out a lot of up-and-coming growth stories in the small-cap and mid-cap space. VTI covers it all. And here's the kicker. Over the last 30 years, total market indexes like VTI have outperformed most active managers. It's low cost, it's tax efficient, and it's proven to be a compounding machine. I wouldn't just invest in it once. I'd DCA dollar cost average into it every month like clockwork. Rain or shine, bull or bear. Because time the market beats timing the market. But I also know that America is no longer the only engine of global growth. That's where the second ETF comes in, VXUS, the Vanguard Total International Stock ETF. Most beginners, and even many seasoned investors, forget how much of the world's GDP, population, and future innovation comes from outside the United States. VXUS gives me exposure to over 7,000 stocks in Europe, Asia, Latin America, Africa, and emerging markets. That includes household names like Nestle, Samsung, Toyota, Alibaba, and more, but also smaller companies driving regional growth in countries with expanding middle classes. Why is this crucial in 2025? Because the world is more connected than ever, but global growth is becoming more fragmented. The U.S. may lead in AI and tech, but emerging economies are racing to catch up with digital infrastructure, energy transformation, and fintech revolutions of their own. Investing in VXUS means I'm not just betting on America. I'm betting on global human progress. Plus, international markets often move differently from U.S. markets. That diversification gives my portfolio some much-needed protection when the U.S. hits a rough patch. It smooths out the ride. Between VTI and VXUS, I've got coverage of almost every investable stock in the world, over 11,000 in total. That's a serious foundation. But I wouldn't stop there. The third ETF I'd buy in 2025, the final piece of my Start From Zero portfolio, is ARKK, the ARK Innovation ETF. And yes, I know this one sparks debate. Some say it's too volatile. Others say it's overhyped. But if I'm starting over and I want exposure to asymmetrical upside, ARKK is the calculated risk I'd take. Why? Because ARKK is a high-conviction bet on disruptive innovation. It's focused on companies that are shaping the future in biotech, robotics, AI, blockchain, and energy storage. Companies like Tesla, Roku, CRISPR Therapeutics, and Zoom. Names that may be volatile in the short term, but are at the bleeding edge of global transformation. Is it riskier than VTI or VXUS? Absolutely, but it also has far more upside potential. The ARKK is my moonshot slice, the ETF that could double, triple, or even 5x over a 10-year horizon if the technologies it's betting on truly change the world. And in 2025, with AI integration accelerating, decentralized finance expanding, and breakthroughs in genomics on the horizon, I want skin in that game. But I wouldn't overload on it. I'd keep it to around 10 to 15% of my total ETF portfolio. Enough to move the needle if it soars, but not enough to wreck my finances if it stalls. That's the beauty of blending core holdings with high-growth bets. You don't need to go all in to benefit. Now let's zoom out and look at how this portfolio works together. VTI is my stable core. It compounds steadily over time, mirroring the productivity and growth of the U.S. economy. VXUS gives me global diversification. It taps into regions with growing populations, rising incomes, and untapped innovation. ARKK gives me leveraged exposure to disruptive technologies and the industries of tomorrow. Together, they form a barbell portfolio, low-cost, diversified strength on one end, and aggressive innovation on the other. And if I had only a few $100s to invest in 2025, I'd still split it among these three. You don't need thousands to start. ETFs are accessible. With fractional shares and no-fee brokers, you can start with as little as $10 per position. What matters is starting and staying consistent. But here's where most people mess up. They don't stick with it. They chase the next shiny object. They panic sell when volatility hits, or they forget to invest at all. So here's the real trick: automate it. I'd set up auto investing. Every time I get paid, a portion would go straight into VTI, VXUS, and ARKK. No thinking, no stress, just wealth building in the background while I live my life. Now, if I were more conservative or older, I might replace ARKK with something like SCHD, Schwab US Dividend Equity ETF, or VG, Vanguard Dividend Appreciation ETF. These dividend-focused ETFs are less volatile and offer reliable cash flow. But since I'm starting over and aiming for maximum growth, the ARKK stays. What about bonds? Good question. If I were close to retirement or needed income stability, I'd consider adding BND, Vanguard Total Bond Market ETF, or TIP, iShares TIPS Bond ETF. But starting from zero in 2025, I want growth. Bonds are good for capital preservation, but I'm in the stage of capital accumulation. I'll add bonds later once I build my base. And yes, I'd still keep some cash, maybe in a high-yield savings account or short-term T-bills. That's for emergencies, not investing. Cash is optionality, not a growth vehicle. Let's talk risk. Every ETF, even VTI, has risk. There are no guarantees. But ETFs spread risk across hundreds or thousands of companies. That's far safer than betting it all on one stock. The key is understanding your risk tolerance and sticking to a plan. The markets will go up and down. Your emotions will get tested. But the long-term trend? It's up. Always has been. And finally, mindset. ETFs aren't flashy. You won't get rich overnight, but you'll get wealthy over time. The point of this strategy isn't to look smart in a Reddit thread. It's to quietly build real, durable wealth. Wealth that gives you freedom, control, options. If I had to start over in 2025, I'd skip the noise, skip the hype, and focus on what works. I'd buy VTI for U.S. growth. I'd buy VXUS for global balance. I'd buy ARKK for future disruption. 3 ETFs, one clear plan, and a future that I'd build one contribution at a time.